Hi, welcome to the Dan Bradbury podcast. Today's show is a special one because if you as an entrepreneur have the ambition of growing your company and having a successful exit, you're going to love this one because it's an interview between Dan Bradbury and Laura Roeder, one of his clients that he's had for a couple of years now. And she had this same goal to scale her company and did it. You know, a lot of people try, many fail, but a very few actually succeed at it. And she was one of them that did so. So you're going to be able to hear her journey on how she bootstrapped her company right from the beginning, systemized it, scaled it, and then sold it. She's actually now started another software company. She's probably going to do the same thing here in another couple of years. But this interview is going to be great because you're going to learn about that journey, some of her highs, some of her lows, and best of all, you'll be able to learn from some of her mistakes so you don't have to do them yourself. So without further ado, let's get to the interview between Laura Roeder and Dan Bradbury.
So for those that don't know, please tell us about what your business is and what it does and still does.
Yeah. So the business is called Meet Edgar. I know we have at least a few people who have used the tool. It's a social media scheduling tool for small businesses. So it sends out your updates on Facebook, Twitter, LinkedIn. I just want to say before I forget, it hasn't been announced to customers yet that we've sold. It'll be announced, I think, this month. So don't tweet about it, please. But I can share it in this room. But yeah,
Get off Facebook, Ross.
It's a subscription software.
Great. So the anyway, there wasn't here yesterday. So you just completed recently. So it's not been announced, but you completed it on the sale of this business. So before we get into the good stuff, and obviously there's certain things that Laura can't share, so I might ask questions and she might just decline to answer because of kind of appropriate legal restrictions. But before we get to the good stuff, like how is it valued? Take us back. Take us back to we've been working together about a year, and so you've got another software company alongside it, Bell, and but Meet Edgar was significantly larger. So at what point did you go, actually, I should consider selling this? Because this business had really grown, been immensely profitable, and then there were some challenges. But what caused you to think about selling in the first place?
Yeah, so the business was launched in 2014. So sort of old for an online software company. I had actually largely taken myself out of the business for about 3 years at the point when we sold. And that was a few things. I'd always been really good about building a leadership team up around the business to run it. You know, I think like many of us here, I was kind of interested in pursuing other ideas. It also was a logistical thing with my move to the UK and the team being based to the US. So I'd kind of taken myself out of the business for a while. And then really the impetus for joining this program at the beginning of this year was that I wasn't happy with the results of the business. The revenue had plateaued. We hadn't grown.
And can you say, because for context, that in the early days, the company grew very quickly. So can you give an idea for the size and scale that you grew?
So we're a bootstrap / self-funded company. I put some of my own money from my previous company in, but we haven't raised any money yet. We were at $1 million annual reoccurring revenue at month 11 after launch. So it was a total like rocket ship, like right place, right product, right time. We grew very quickly and we ended up getting to like $1 million a year in revenue was the most the business ever made.
So more 7-figure revenue, and then you kind of extracted yourself because you came over to the UK, but management team in place. And sorry, I didn't interrupt you. So you just talking about what?
I was saying I had joined because I was unhappy with the results and I wanted to make some sort of, I'm like, okay, do I want a new managing director to come in? Do I want to totally restructure the team? Do I want to come back in and run it again? And actually what was really valuable is, you told me to make, I call it an options matrix. Is that what you call it? Okay. And so maybe, you guys have heard this idea from Dan, just means like list out all the possibilities, the different criteria. For me, it was things like taxes and my own time and my own interests and lots of different factors for the kind of different options I had. And very short version is, that definitely led me to know that I was ready. And it was kind of the right decision for me just to sell it entirely.
Yeah, good. So on that one, it often feels like, I wouldn't say this is stereotypical, but there was a lot of moving parts for Laura's world, right? So there was a lot of things. So you go, okay, well, maybe because of this, we should do this. Oh, but because of that, maybe we should do, and then it kind of got spiraled. So that's why it's helpful sometimes to document it on paper. It's useful to get a group of peers, kind of outside counsel, like a private mastermind in this example. But equally, you still, if you're not careful, you just get lots of different ideas and you spin round. So then putting it down on paper so you can see side by side, in the same way that you see financial trends, it's like, okay, what are the most important criteria, weighing up the options against each other. And then quite quickly after that, I remember, I think he dropped me a text or a note and said, oh, okay, I'm going to sell. So then we'll go into the journey before we get to the punchline. Where did you start? Because there's some people in here that are either might be saying, I want to sell one day. Where did you even start with that process? So you've got a business. I've got a profitable business. How do I sell?
So I started by learning. So I read all the books. I mean, I literally read all the books. I just went to Amazon and I'm like, if this is a book about how to sell your business, I will read. There's not that many of them. There was like less than 10 of them. So I'm like, I'll just read all of it. It doesn't take that long to read a book. I'm like, I'll read all of them. They were really repetitive. That made it even shorter. I could just skim a lot of it. And I will say there's only one book, which is The Art of Selling Your Business by John Warlow. He has a more famous book, Built to Sell, that's about how to build your business to be sellable, which is also an excellent book. But The Art of Selling Your Business, John Warlow, is specifically about the process of selling, which there are not many books about that specific process. So that's really the only one you need to read. I also listened to a lot of Built to Sell podcast episodes, his podcast where it's just people's journeys. I talked to people who had sold their business. So that was the first part, just like, yeah, I've never done this before, sold a business before. So I need to learn what the whole thing looks like. I learned pretty well, actually, from doing.
Yeah, good. Yeah, John Warlow was great. By the way, I interviewed John on my podcast. If you look back in the feed, you'll find him somewhere. And actually, John interviewed me about one of my exits on his podcast some time ago. So yeah, he's a good author as well, because he's got another book which is about recurring revenue and building recurring revenue streams. But anyway, so you learned a lot. Okay, now what? Well, what was internal? What did you need to do internally, and what did you need to do externally to actually find buyers?
So I started by interviewing and talking to some brokers, and that's a very fraught world. I mean, I remember talking to you saying, I think this is kind of a scam, and you're like, yeah, that one is a scam. There's a really wide range. They call themselves so many different things, M&A advisors, investment bankers, brokers. There's a lot of it out there, and a lot of it does depend on your industry. So I definitely spent some time interviewing various types of firms and various people, and I ultimately decided to run the process myself.
Just to speak to, since you use the word scam, just yesterday there was someone in this room that said, "Oh, Dan, I've been approached. I've been off this letter. Send this letter saying blah blah blah. I want to value your business, etc." Which made me laugh. So the person who's still in this room, I've just not asked permission to share who it was. I actually got an email last night from a company offering to value my company, and I was saying, look, in most cases, it's a proper cowboy world, the kind of business brokerage space, and they're just trying to set you up for paying them a load of fees. So all of a sudden, when people start talking about exits and millions of pounds, then all of a sudden it becomes, if you're not careful, easier to justify, oh yeah, paying tens of thousands in fees, that's perfectly reasonable. But I'm going to make millions, which of course rarely transpires. So it's definitely big Wild West cowboy territory. So ultimately you decided to sell it yourself, but how? I mean, how did you think about who's going to want this business?
So in broad strokes, there's what's called strategic acquisitions or financial acquisitions, at least in my industry, but I think it applies to others as well. So yeah, so a strategic acquirer means that, can you explain that?
Yeah, sure. So a financial acquisition is typically somebody with money is literally buying the business for a financial return. So it's often, but not always. So some of you guys have seen at previous skills days, my friend Simon Intry, private equity, a lot of times they've got pension fund money, and the pension fund are going, here's £750 million, buy companies, and you just need to get us a 7% return, or whatever the number is. and are literally investing it in companies that are solid, stable, real estate portfolio, stuff where they go, we're just getting a return. That's all they're after to grow, in that example, the pension fund. They just want a return on the money. A strategic acquisition is typically somebody in the same industry, or it can be in a similar industry where there are synergies. So they can often justify paying more because if you've got two businesses at the same time, you can put them together, and there's cost synergy. So you don't need two bookkeepers, you don't need two office spaces. Probably so your costs go down, your profit goes up, and often your products from company A can be sold to company B's customers and vice versa. So revenue goes up and cost goes down when it goes well. That's a strategic buy. Somebody, it's not just I'm buying this company in isolation just to make the money it makes. It's they see somewhere it can go that can benefit the acquirer beyond just the money the company makes.
Yeah, so strategic is definitely considered better because it usually has a higher multiple. But the thing about strategic, if you're like outbound looking for interest, is you have no clue if they have any interest in buying a business, buying your business. So if you go to potential strategic acquirers, it's going to be a longer process. Like for me, that might have been approaching like a MarTech company or something like that. I have no idea if they're interested in social media, if they're making acquisitions. It's going to be, usually at least like a 9-month process, getting to know them, blah, blah, blah. Whereas financial, I have a profitable SaaS business. They buy profitable SaaS businesses. I know there's at least going to be interest there, right? Like they're actively looking to buy businesses like mine. So for me, strategic, one, I didn't have any obvious interest. So like I'm in a very hot market. So you do get a lot of like inbound interest. And I didn't really have inbound strategic interest. So I knew it would be a very long process of dropping it all up. Where when I looked at the financial side, so what I ended up doing is saying, okay, I'm going to focus on a financial buyer because I kind of know how to do that. It can be quick. And I literally just Googled, just like I read all the books. I just Googled, okay, I'm going to find any sort of firm that buys, mine is considered like a smaller SaaS company because we haven't, we're not in hundreds of millions. We haven't raised a ton of money. I'm just going to Google whoever buys small SaaS companies. And I found like 20 of them. Apparently I Googled well because one of them said, how do you find me? We're not on the internet. I don't know how you found my email. I'm like, I found your email somewhere. And I just reached out to them, which was great because the whole point is they're looking to buy SaaS companies. They're not like shocked and offended.
I do love that. I got to give you a compliment. I mean, in this room, amongst people that are action takers, but you especially show some of you go, I don't know where to do it. I don't know what to do. So I just won't, I won't do anything. Meanwhile, Laura's just Googling, Google, search, the answer's there, just Google. Like, who buys small SaaS companies? And then I end up finding something. I'm thinking, 47 figures cash. I'll take that. So you basically you did outbound to narrow down some leads because ultimately this is a sale, right? Anybody going in to get a customer, you get leads, you work leads. You effectively got a list of potential companies that buy SaaS companies like yours, which means that they're going to be quicker to make a decision than a broader kind of private equity type fund because they know the sector, so they can immediately identify the metrics to go, yeah, that's the right fit for me. All right, so what happened? So how many frogs did you have to kiss before you found the prince? What was it? Oh no? Was there a lot of interest? What was that?
There was, almost everyone wanted to have a conversation. The only people that didn't want to have a conversation were if they're like, actually, like, we bought a few SaaS companies, but we're focused more on real estate now, something where it was just really not a fit. And I was very transparent with our information right from the beginning. That's just how I just didn't want to do a lot of game playing of like revealing, slowly revealing information over. I just wanted to be like, here's what the business says. Like, you can decide if it's going to be a good fit for you. So, I gave a lot of, I did get on a call before I gave them, and like, I gave them something, very, very broad. And then once we had talked.
What does that mean? Does broad mean, when I sort of use the term, so, not necessarily an IM, but was it you each went, this is a company, were you giving them headline revenue figures? Were you giving them?
Yeah. I think just even because, sometimes in these things, there's like this thing where you don't even reveal what the company is. You're like, we have a B2B software company. So
sign this NDA.
Look up the company. This is what it is. This is, like our annual revenue. I think that was kind of, basically it, or kind of top line broad strokes before we got up.
Great. And then how many people did you speak to?
Probably spoke to like 10 people. Yeah. And the whole process went really quickly. Sometimes they were moving it along. Sometimes I was moving it along. I ended up having one company that was obviously serious, who's the company that ended up buying, and then a few companies that were maybe serious and sometimes would take a while to get back to me. So like the maybes, I would kind of prompt them, okay, like, you're not the only one, right? I'm having conversations with other people. And then I was also able to leverage the maybes for the serious one. And basically the crux of the negotiation ended up being me saying, okay, I'm willing to close it. Like I told them that I didn't have an offer from the other ones, which, you could think would be like a bad thing that I didn't have an offer in writing. But what I told, I'm like, these guys are going slow and like, they're not as fast as you. So if I can get a number that I'm happy with, I'm willing to just, agree to you before I even get a number from these other companies. So that's how, even though the other companies weren't as interested and like, maybe they weren't really interested at all, that's how I kind of leveraged that for the company that was interested.
Good. I like it. So let's talk so that really can talk about valuation. Well, so how, because I remember my recollection was we'd had a conversation in a private mastermind meeting about, okay, how much do you want? Right. And you'd said a number and I kind of poo-pooed it a little bit and kind of go, felt a little high for me or my judgment. And I think, but I give you the disclaimer, but to be fair, I'm not in software. It's a hot market. But like, how did you value the company in terms of what was the criteria that you used to come up with a number that you'd be happy with? And then how did they value it?
So the way I thought of it, and this is advice that you helped me with, is like, I need to figure out my own number. And my own number wasn't honestly really outrageously high. It was kind of me doing the math of different scenarios. Also, it's worth noting, taxes play a huge part in this because I'll pay capital gains tax on the sale of my business, but I just pay, normal income tax on generally the money coming in from my business. And obviously you have to look at your own situation. But for me, those were extremely different tax scenarios. I'm literally paying about half the tax rate on selling the business versus just collecting the ongoing revenue, which is why the math worked out to have maybe like a lower, like I'm good with this price that you might expect. So that's just, I had never thought of that before this. So that's kind of an interesting thing to look at for yourself. So I just set the price in my head of like, this isn't my, it's hard. It was interesting what Lisa was saying. We obviously have these attachments to our business to think that it's like the most amazing thing ever. So it wasn't about like how much the business is worth. It was more just like, this is kind of the financial outcome that I need to sell it and not hang on. Because I could have also hung on to it and just collected the revenue from it. That was another really great alternative for me. So it's like, this is the number that would make it worth it to sell it. I know that number for me. I'm really going to let sort of the market tell me what their price is. That's just kind of how they viewed it. Like my number, I was confident was a reasonable number. I can tell what their number is because I had multiple people involved. So if one is crazy low, you know what I mean? Because there's more than one person out there. Because we would talk sort of like multiple ball, even though I didn't actually get an LOI from anyone else. Like
LOI stands for letter of intent.
Letter of intent, that's like the offer. We would talk about sort of multiple. So that's how I
saw it. So then break it into multiples. So it's slightly different in this sector. So for clarity, typically in business houses for a multiple, they're talking about a multiple of the profit, whether that be operating profit, EBITDA, or some kind of profit number, because that's a multiple of that is a return for shareholders. So if you sold for 4 times your profit, it's a 25% return on your money, right? So if the company makes 250 grand a year, you buy the business for $1 million, that's 4 times the profit. So it'd take you 4 years to make your money back. So 25% return on your money. But in the SaaS business, it's done a little bit differently.
In some of it, it's a multiple of your gross revenue, which I know seems a little crazy, but that did turn out to be true. All the conversations only talked about multiple, in the sense of your top line.
Recurring revenue.
Recurring revenue, annual recurring revenue.
Right, and the reason for that is because I actually sold to I'd sold a business of mine, which wasn't SaaS, to a SaaS company before, and it's quite interesting. But the reason for that is, think about this: if we own a group of SaaS companies and we buy Laura's business, why do you think that? I mean, you could just buy it for revenue. It's a lower. It can be a lower multiple. But why would they assess it that way? Why would we assess Laura's business and say, okay, we can just look at the revenue, recurring revenue we're buying, not look at the net profit? Go for it, Alexis.
Assume that a load of costs they're already incurring will be the resource that you then use because you haven't got a load of cost of goods sold.
That's it, right? So ultimately, and again, in a sense, you could say it's a strategic buy because they're going, we don't need the developers that Laura's got because we've got our own developers. We don't need Laura's salary being included because she's selling the business. So that's that. So all of a sudden they're kind of going, all that revenue will be our profit, right? And really, even though this is say a multiple, I guarantee you they internally are doing the math. Even though they said that they summarize it this way, internally they've done the math and went, okay, if we do this and we'll do this and we'll have to put this money in and we'll spend this money on marketing, or we're going to have to put more dedicated devs on this, or we've got to, right? And they'll do the math and then they will have figured out an ROI where they go, right, we're paying this much for the asset and we're going to get this much back in profit, net over time, right? So sometimes it's, even though it's a useful shorthand, it can be an oversimplification. But, it's a multiple of your profit. And that's what the company will sell for. Well, that's not true, Omar. It's what people are doing the maths at. So on that basis, can you speak generally about what the multiple is for SaaS companies that you found from your research?
That part was totally impossible to find. So that was one thing that in my research was just sort of useless because, like all of our industries, there's so many private transactions out there. Maybe the difference between SaaS is that the numbers get so crazy. I mean, the ultimate one is Instagram, which sold for $1 billion when they had a team of like 12 people or something, right? I'm obviously not Instagram, but there are companies that are not that dissimilar to mine that do have strategic acquisitions for 15 times revenue. Like that can happen in my industry. So I found it really hard to get any sense of kind of what to expect, which is why I thought of it more like I'm going to let these people like tell me when the sort of market is saying.
Right. But Instagram's a good example. I don't know Mark Zuckerberg that well. So this is my opinion all from what I read. But why did Facebook buy Instagram? Were they doing it as a financial purchase? No, because it didn't make money. It was strategic. What was the strategy behind it? Yeah, ultimately they were trying to take on Snapchat, right? Again,
I've seen it.
Correct. They took on Snapchat and they went, oh, this company is going to. I believe they observed and went, this company is going to eat into market share, and this is where it's going. So we've either got to develop ourselves, or we've got to buy somebody. Allocation of capital. We've got to buy somebody that gives us a quick start. And then, of course, they bought Instagram, and then they ultimately the thing that was really the final punch that knocked out Snapchat was was it the stories feature, which was what I believe Snapchat was uber popular for, and then Instagram developed and launched the equivalent feature using the money that Facebook had funded it with, and then all of a sudden Snapchat usage plummeted and Instagram took over the world. So strategic purchase. You go, oh, it's ridiculous. Why would they spend that much money by Instagram? Well, I'm pretty sure the board at Facebook aren't complaining about that purchase price, right? Doesn't always work, mind you, but in this case, well. So so taking into the negotiations now. So how much did the number shift? So ultimately, you've given financial disclosure, and they made you an offer. Yeah. How did that offer compare to your number?
Well, there was like a sort of verbal offer on the phone. The offer they actually came in with at the LOI was maybe like 20% higher than what they'd said on the phone, actually. And then we ended up maybe another like 20% higher.
Yeah. And how did that initial number on the phone, how did that compare to your number? So again, don't read into this. I'm just using it as an example point. So if they'd said, if you'd valued it $1 million Was their offer higher or initial offer higher or lower than your number? Yeah. Good. That's all I need to emphasize. So actually straight away, I felt that Laura had, even though it felt a bit high to me, I felt that she'd been realistic when she'd come up with her number. I went, okay, yeah, I can see how this could make sense for the right party to buy this. And then straight off the bat, first offer, higher than what Laura's number for going, yeah, this is an acceptable deal. Good. And then what allowed you to shift it upwards? Because it went up by 20%, so it went up by 40%. So this...
Lisa Cato recommended the book in the Facebook group, Winning Through Intimidation. It has the funniest title. That book totally helped me with my mindset so much.
Robert Ringer, Winning Through Intimidation. It's good. I think it was written about 1980.
It's old.
It's an old book, but it's great. It's basically, allegedly, I don't know if it's true or it's fictional, a bit like Rich Dad Poor Dad, but it's the story of a realtor in the US who sold high-end homes and how he went from being bottom of the rung to being one of the top producers in the United States. And it's not actually about intimidating other people. But it's a clever title. It's really saying about how to avoid being intimidated and taken advantage of.
That's something other people intimidate you. And like, this sounds funny, but I swear this is how I practice something that I was learning from the book. I'm redoing a house right now. And so there's, all these like fancy high-end like kitchen and bathroom stores in London. And these stores, like, even though they have a retail storefront, they keep the door locked. And when you go up, they're like, are you, a designer or architect? Do you have an appointment? They're so pretentious. So we were in London, like looking at all, and I actually genuinely didn't even know you're supposed to have an appointment. We're in London, we're going to these shops. And I had been reading the book and I'm like, I'm not going to let like this person from like the toilet store intimidate me, right? Like, it's like, cause they try to be really intimidating. Like, oh, you can't look at our toilets. Like they're too fancy. So I would go to these shops and I would just blag, am I using that correct? Blag my way in, to the shops. And it was actually like a great little exercise in like, obviously not being rude or anything like that. You're just kind of not playing their game, I mean, just saying things like, oh, it's not a designer, but, I just wanted to
do you know who I am?
And just kind of assuming that they'll let you in, like just having that attitude of like, oh, of course you're going to let me in. To look around for a few minutes, and then they do. And it was this like little example of a small, non-important situation, not having the other person be in that intimidating power position. So yeah, the mindset from that book was so helpful for me in just remembering like, I have the power here. They want to buy. I have the asset that they want to buy. This is not my only option. They are not the only acquirer. I could just keep the business. I collect the revenue. So just, you do kind of have to like, I think, hype yourself up a little bit about how amazing your asset is, especially because normally the strategy of the other party is to tell you how much your asset sucks. Like at first they tell you that they love you and they're amazing and it's such a cool business. But then once it gets up to the
found this problem.
Yeah. It's not a problem. So it's really important to like hold on to your own mindset of how amazing it is.
Yeah, I love it. So I remember after the first number was mentioned, I remember because you shared it with me. I remember, oh, this is great because I'm like, well, we already know we're home, but equally it was like, oh, they've led with that number. I was like, well, they're going to go higher. Yeah. So well, could you give examples if you're able to? What did you say to? How do you politely say, no, I don't want your multi-million-dollar offer. I want more, right? How?
So my philosophy is always like that, just to not kind of argue about why. Like I would say like, this has to make sense for both of us. Like you guys need to work out them, because they would say like their reasons would be things like, oh, we're going to, need to hire this like larger development team. And I'd be like, you guys, need to work that out on your spreadsheet. And I just, you need to make an offer that the math makes sense for you. And I would just say something like that. That's not quite the right number for me. It needs to be higher.
Because so it went up 20%, went over 20% again, so we're 40% above the initial offer, whatever that was. And the initial offer was already above your number. Good. How did you know when to stop? How did you know when to take it?
No, stop. I guess it just felt like kind of the natural. there's like natural expectation. A lot of us have done it with a house, right? Where you do the thing where it's like they say 100 and you say 120 and you both know that it's going to be 110, right? Like those sort of things. So it was that kind of patterns. And I don't know if it actually ended up being 40. That sounds high. So, but like you said, these are all sort of big ballpark numbers, but it was higher. And the other thing I remember, because when I got that first verbal,
I think it was, by the way.
okay,
But yeah.
you're doing the math, yeah. When I got that first verbal offer, my husband was like, take it. Like, see, like he was just like, oh my God, that's a great offer. Take it. But I remember saying to him, so you think their strategy is to just come in with their absolute, like, best and final? Like, that makes no sense. Obvious. Like, why would they do? And especially they're professionals that fly a bunch of companies. Like, obviously, their strategy is not going to be to come in with their absolute stretch highest number. That would be so stupid of them, right? So just knowing that, I knew that they obviously had room to go higher. I do kind of think that there was room. Like, I definitely think it's possible that I could have gotten more, but I guess I stopped when it felt like I wasn't like, I don't know, like digging and like I was like, okay, the number that we're at, like I feel like you've gone up, but it still like feels reasonable to you. It feels reasonable to me. I'm happy with it. I feel like we can now not keep going and going and going.
Well, that was my observation point is that from the outside, it never felt like Laura was putting the deal at risk, right? So it never felt like, oh, it's getting really tetchy now, because I'm not. And it actually reminds me of something that Emma said yesterday. It was kind of a parenthetical comment, which was very, well, it's easier to take more risk when you're more secure. So obviously without probing, you're in a financially secure position where anyway. So it wasn't like, oh my God, if I don't take this exit, like the company's bankrupt and I'm ruined. It's like, okay, so I think it probably it's fair to say it helped that you kind of go, well, obviously you don't want to turn down a very good cash offer, but at the same time, you kind of go, if you'd gone on for, I need a little bit more, they'd said no and taken the toys and run away, you would have probably been pissed off, but it wouldn't have ended you. You would have just gone back to the market and gone, okay, I need to find somebody else that's willing to buy for the asset. So,
and also it's important to remember that like it's not. So yeah, if that had happened, and they'd said no, then I could just go back again and be like, okay, never mind, I'll take your other offer. Like these things aren't actually like, unless you have some huge ego in place, the other person's not like, I am so offended that you said no to that. And also that's like, we did have a good relationship throughout, and that's the other reason I didn't feel like I wanted to push it over the line to keep digging and digging more, is because I felt like, it would, maybe the relationship wouldn't feel as good.
And so now let's talk about the closing. Actually, I want to emotion about what it felt like, but one last thing before that, because I know there's one of the members who's not here who exited a small one of his businesses recently, and there's somebody else in here that is going through a transaction. And often these things can be grueling with the lawyers and the accountants. What was your experience of that, or what would your advice be?
Mine was not grueling. I think I just got very lucky. Like the company that bought mine has bought 40 other SaaS companies. They had their process down. They were very good about like not playing games. I also did call other companies that they had acquired. I didn't mention that detail, to ask them, to these guys, F with you basically in the process. And I asked, was your LOI price the same as the final price? Because some companies have a strategy of giving you a high LOI and then chipping away at it during the process. So I found out that.
Actually, that's a good point, because by the way, there can be risks. So some people will go to market, competitors will go to market just to try and scrape, get insider information, because NDAs are often signed, but they're notorious. It can be very difficult to enforce. So competitors are literally going, I want to look inside your books. I want to know how your company operates. I want to understand how all this works. And they're pretending like they've got a big pot of money. So you show them everything, but actually they were never, ever going to give it to you. So that is a good, important due diligence piece.
To mention is I was prepared. So I had interviewed 3 different M&A lawyers before, like really when I was still in that book reading, researching phase. Because I remember actually they all said like, that no one does that. They said people come to them like once they have that LLC, that people don't interview them ahead of time. And I ended up, the one I liked best, I ended up getting some advice on it from him about another thing. So then I had a little opportunity
To try them out.
Yeah, to get a little sample of working together, which was great. So then by the time the LOI came, I had my lawyer in place. He was already familiar with the business. He was able to review it really quickly. So, I can share how much I spent on the lawyer. This is an American lawyer. I ended up paying him about $25,000, which is what he quoted me was like, that was the bot. He said, when I first talked to him, it could be like 25 to like 50,000 or more if it goes on for years, obviously, but that's kind of what you can expect, because it had gone pretty like quickly and easily.
Yeah, good. It's a good reference. I mean, don't try and take that too much because it varies massively on the size of company and the complexity surrounding it. So the fact that the buyer was pretty slick, had their act together, knew what they're buying, and in many senses, a very simplistic business to buy, right? It was very lean, very high margin, been around for years. Okay, we need to understand the tech behind it, but that's about it. Now, just briefly, what about accounting? Because you referenced it, and we, again, not going to the nuances of tax, but your situation's different in the US citizen, but living in the UK, etc. So it made it more complex. But the point I want to emphasize to the room is your personal circumstances can make a very significant difference to the net. So, or kind of said for simplicity, okay, like I'm paying half the rate on the capital gain than I'm going to pay on the income because of how it's structured. So therefore, looking at the net number to Laura and her husband, changes the proposition. So I can have this revenue stream and these profits over time. Okay, and pay tax at this rate, and then I get to this number. I can have this now, but of course, the $1 million question is she's now got this money but doesn't have the asset. She's sold the golden goose, killed the golden goose. But then, of course, if you think about yesterday, partly Laura's and her husband's thinking is about, what do we do with this pot of money? How are we going to allocate that capital? What does that mean for us? So tell us about closing. What did it feel like?
The negotiation was way more exciting than the close.
Oh, really?
Yeah. Like, you guys know how this stuff is, right? When you reach the goal, you're like, okay, like, and then, so the negotiation was the fun, exciting part. And I think because the actual close, like, then, I mean, mine was there was like a 30-day due diligence, so the whole thing was quite short. But of course, it's all done online, so you don't even get to sit in a room and sign papers. Like, they literally just send you a DocuSign. And then there's an escrow company, that does a wire transfer. For me being in the UK, though, I did have to stay up late to wait for the wire. I was just waiting for them to do that.
Refresh.
But yeah, it is all a little anticlimactic because it all happens digitally, and because it's coming. So actually, emotionally, the close was much less of an exciting milestone than when getting that first offer was really exciting. The negotiation was exciting. And when they sent over the LOI, because that was the real offer, that was exciting.
Nice. Have you guys done anything to treat yourself? You haven't really. Disappointing.
Oh, wait, we did. You know what? I can pretend it was, we went to the, for real, we're reaching like a whole house, so it's really expensive.
That's how she bragged away in. Look at my bank statement. I mean, I had to buy this whole shop.
Okay, anyway, this is just the treat yourself tip. We went to the luxury brand. I don't know how to pronounce it. Bulgari. Okay, so they have a hotel and spa in London, and it is a really fancy spa. And we did it for our anniversary, but I'll pretend we were celebrating. So we did a spa day at the Bulgari spa in London. So I would recommend that.
Yeah,
it's a treat.
Good. I just to say, what's the dark side of selling your business? So Laura's got another company, and now lo and behold, Baby Bell has had consecutive record-breaking months, and it was already doing well, to be clear. But it's not similar to Lisa's. Now we've got the focus on this one thing. Unsurprisingly, it can take off. But I will say, for just those that consider an exit, be clear about what you're doing afterwards. It's seen over the years, seen a fair few where they've sold their primary business and that's it. I'm done. I'm out. And it can be almost sending me through of R&MD. It feels good for a period of time, and then there can be a little bit of an emotional crash if you're not clear about, okay, what are you going to do next? what is it going to mean to you? But you did make me laugh. I would have thought you would have, when the money got in, I would have thought you'd been really excited. Because by this point, I was texting Laura saying, right, tell me when it lands. Tell me when it lands. And when it landed, I had a little celebration. Right, it might have been a cup of coffee, but I was like, you made my day. But just tell one other funny escrow story. It was about anticlimactic closes. The other member that closed the business recently, the deal closed. The money was going into escrow and should have been sent to their account. The money just never arrived. There's like, what's going on? 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 Eventually, it turned out there was something wrong with like the account name. So his bank got the money and sent it back. And it was transatlantic, so they were selling across the pond. So basically, long and short of it was, because it was sent back, it took 6 days. So he was like, yeah, I've closed. I've got this big pot of money. To which I was also being annoyed because I was on top of it saying, tell me when the money earns. Still running back to play. It's not fucking here yet. But anyway, all's well that ends well. So, Laura, I actually got a couple minutes quickly. Any questions? Because I've just been piling on the questions. Questions for Laura, we got 5 minutes. Yep, go for it.
So I've got negotiations from the initial offer that you had verbally through to accepting the final offer and then getting the ROI. How long did that take?
Maybe about 2 months, maybe even a little less than that. Yeah.
It was speedy.
Yeah, which is very fast. Like I said, I consumed a lot of stories about this. I mean, just the LOI negotiation can be 6 months sometimes. Also, my business is like just shockingly simple as far as all of our money is in one Stripe account. No one mails us checks. We don't have any like custom contracts. So as far as doing like vetting and research and things like that, it just could not.
Same products, basically.
Right.
Yeah. No worries. Rob?
You worked like pretty well, guys. Congratulations. It's been a bit of a roller coaster this kind of last year. I'm in the property space, so our plan as well is to exit. So really curious about how it's kind of gone for you. Question I'd probably ask is there anything you would do differently, having gone through that kind of experience?
Good question.
Is there anything you've learned?
Yeah, so I mean, probably the most valuable learning was what the acquirer looks for. And at the time of the sale, we had this is like a whole other story, but we only had one part-time freelance developer in place. And that was a huge downside from the acquirer's perspective, which I did not know because, as you know, it's really hard to find developers. Obviously, there's a lot of institutional knowledge about the product that comes with your developers. So they actually wanted a good, solid development team. They didn't care about any other parts of the team, but they wanted a core development team to come with the sale. So now I know more just kind of little details like that of what makes a great acquisition.
All right, very nice. Jacqueline, and we'll go to Alexis, then we'll go to Georgia.
Ask the people that were working for you how they felt about this process and how much did you involve them in it?
So there were no people working for me when we sold the company. We had restructured the team to only a few freelancers. So it was, a weird case where there were no full-time employees at the time of the sale.
So they didn't know anything about it until it happened? But then part of the deal later to carry on working?
No, so it wasn't a big deal to the freelancers about it because this was just kind of they're just clocking in, clocking out hourly job. So there was a point when they were told about it so that they could help with due diligence, some people, and it was a very different vibe than a full-time team that's been there for a while and it's going to be emotional for them. The company that acquired it was very weird about the people, how they sort of transitioned to people. The one developer that I mentioned, they had said that he was going to be really crucial to the deal, and they even mentioned wanting that in the contract, that he was going to keep working there. But then they said that he was way too expensive. Apparently they only pay really cheap rates. Then they didn't want to pay his rate. So they weren't as bothered as I would have been about keeping him. They ended up keeping one person who was doing customer service. The other wasn't interested in moving with them. Their structure is to have like a big team that works on all of their businesses. So obviously it depends a lot on, you know, how the acquirer is going to like integrate the business into theirs.
Good question. Thanks, Jacqueline. Alexis?
Does they get into like code quality and the products and stuff? Because that makes a huge difference in terms of how difficult it's going to be for them to maintain the brand marketing and so on.
So I think, yeah, before the LOI, we had one technical interview where really they're making, you know, so for you guys to know, they want to know that you're not using crazy stuff. They want to know that you're like, we're using this weird French programming language that you can never hire a developer for, you know, and we created our own system instead of just using the database that everyone else uses. They want to know that you're using best practices, regular stuff, so they're going to be able to come and put a team on. So that was kind of really the gist of the technical interview about, you know, kind of the languages, systems we use. And then once we were in due diligence, you know, we just gave them access, read-only access to GitHub. So again, it's just a business so for anyone who doesn't know, that's where the code lives that makes up the software. So it's just a really easy business to vet, you know.
I like it. Final question, Georgia?
Congratulations.
Yeah.
Was it girls out into us? I
just repeated for the mic because this mic's turned around so it wouldn't have picked up Georgia. So Georgia said, was the company built to sell? Did you build it with that, the exit in mind?
So yes. From day one, like I mentioned, I had always been really good about not having the company be dependent on me. For me, that was largely motivated by having time freedom and not being tied to the company, but definitely also with the idea to sell. It's also just not the type, like, who keeps a social media scheduling software for 70 years? It's just not really a business that you can envision, like, passing on to your children. It's a very, like, it's going to have expiration date on it in some sense, or major changes or whatever, you know? So yeah, I definitely always had the idea that it would be sold at some point.
I love it. Well, phenomenal, Laura. So for a multi-7-figure cash exit, mastermind member of the quarter, give it up for Laura Roeder.
I hope you enjoyed that episode. 3 things you need to do now. Number 1, make sure you subscribe to this podcast so you do not miss an episode. Also, get on over to Amazon to get a copy of my latest book, Turnover is Vanity, Profit is Sanity, 9.5 steps to improving your profits and cash flow. Also, join our Facebook group, the Turnover is Vanity, Profit is Sanity community, to connect with other business owners.